Today, we're digging into something that's quietly reshaping a huge part of finance, even though most people never see it up close: AI's impact on private capital markets. That's private equity, venture capital, private credit, growth funds, secondaries, real assets, all the behind-the-scenes machinery that funds companies before they're household names.
And it's a perfect topic because private markets have always run on information advantages. If you can find a great deal before anyone else, understand it better, price it better, or manage it better, you win. So the obvious question is, if AI is a machine for finding patterns and compressing time, does it erase the advantage or amplify it?
Let's set the table. When people say AI in private capital, the superficial version is, oh, cool, they're using chatbots to write memos. That's not the story. The real story is AI creeping into every step of the investment lifecycle: sourcing, screening, diligence, execution, monitoring, value creation, and even fundraising.
So we're going to walk through those steps, call out what actually changes, and then get into the second-order effects: competition, regulation, talent, and what returns might look like when everyone has access to similar tools.
Let's start at the top: sourcing. Historically, deals come from networks, bankers, conferences, alumni circles, founder referrals, and institutional relationships. It's high-touch, relationship-driven, and, honestly, often gated.
AI starts poking holes in that gate. Not completely, but meaningfully. Funds can use models to scan for signals that a company might be a fit before the company is officially for sale or before a founder ever pings an investor.
Signals like hiring trends, job postings, leadership changes, shipping activity, app download momentum, web traffic, review sentiment, contract mentions in public documents, patent activity, even the way a company's product is discussed in niche communities.
And it's not just finding companies. It's ranking them. Instead of an analyst building a list of 200 targets and manually updating it, you can have a system that continuously refreshes the list, flags anomalies, and says, "This company just had a meaningful inflection in growth or margin or retention. Go look now."
But there's a catch already. If everyone is scanning the same signals, then the act of finding the company isn't the edge. The edge becomes what you do with the lead: how fast you can validate it, how credible you are to the founder, and whether you can structure something better than the next fund.
Which leads to screening. A lot of funds get buried in inbound teasers, data rooms, cold emails, decks. AI can triage. It can extract key metrics from decks, normalize them, compare them to benchmarks, and toss obvious mismatches into a no pile quickly.
In theory, that's great. In practice, it raises a brutal question. What if your model is trained on the last decade of winners, and the next winner doesn't look like that?
Exactly. Private markets love pattern recognition until a new pattern appears. If AI screening becomes too rigid, it can standardize thinking. You might reject weird, non-consensus ideas because the model can't see around corners.
So the best teams treat AI like a junior teammate who's fast, tireless, and occasionally overconfident. It can sort, summarize, and suggest, but humans still decide what deserve a real look, especially the outliers.
Now we enter the most famous part: due diligence. Traditionally, diligence is lots of manual work: financial analysis, market sizing, customer calls, reference checks, legal review, quality of earnings, operational deep dives, and building an investment memo.
AI speeds up the parts that are basically information processing. For example, you can ingest a pile of contracts and pull out renewal terms, pricing escalators, change of control clauses, and concentration risk. You can parse customer transcripts and see repeated pain points or churn drivers. You can review product reviews and spot themes that correlate with attention.
And you can do scenario analysis faster. Not just base, upside, downside in a static spreadsheet, but more dynamic simulations, like what happens to cash flow if customer acquisition costs move this way, if churn ticks up, if interest rates change, if supplier lead times slip.
Here's where I want to slow down. Speed is great, but diligence isn't just a race. It's also judgment. AI can highlight inconsistencies, but can't fully answer questions like, is the CEO reliable? Does this leadership team execute? Is the product actually loved, not just tolerated? Is the market really as big as it sounds?
And there's another risk: false certainty. When an AI system produces beautifully formatted output, it can feel authoritative. People might forget that the inputs can be incomplete, biased, or outdated. A confident summary is not the same as truth.
So a practical rule emerges. AI is great for finding needles and inconsistencies, and humans are great for decide what the needles mean.
Let's talk about execution and deal structuring. Once you decide you want the deal, you negotiate terms, build legal docs, align on covenants, plan governance, and create incentives. AI can help draft and compare language across documents, detect unusual clauses, and map terms to market standards.
It can also streamline internal approval. Committees want consistency. What's the thesis? What are the risks? What's the plan? AI can help generate first drafts, cross-check numbers, and ensure the memo aligns with the model, not replacing the IC discussion, but removing the friction that eats weeks.
The big private capital question is, does that compression change pricing? Because if high-quality diligence becomes faster and cheaper, more bidders can show up confidently, and auctions get hotter.
That's a key second-order effect. AI can make markets more efficient. And when markets are more efficient, pure alpha gets harder. That doesn't mean returns disappear, but it shifts where returns come from.
Which brings us to portfolio monitoring. After the deal closes, funds track performance, monthly reporting, covenants, budgets versus actuals, operational KPIs, and early warnings.
AI can automate the boring but critical work of turning messy company data into a clean picture and then spotting changes early. Think of it as a radar system. Margins drifting, churn rising, pipeline quality changing, usage dropping in a key cohort, collection days creeping up.
And in private credit, this is huge. Lenders live and die by monitoring. If you can detect stress earlier, you can renegotiate, add controls, or reduce exposure before a small problem becomes a restructuring.
It also changes board work. Instead of board decks being backward-looking narratives, you can bring in near real-time dashboards and forward indicators. But again, there's nuance. You don't want leadership teams managing to the dashboard in a way that hurts the business.
Now the part that might be the biggest driver of returns: value creation. Private equity especially has moved from financial engineering to operational improvement. AI becomes both a tool and a product strategy.
Right. Funds can help portfolio companies use AI to improve pricing, reduce customer support costs with better self-service, optimize inventory, improve sales targeting, speed up underwriting, reduce fraud, automate compliance checks, or personalize marketing.
And for software businesses, it can be existential. If a portfolio company's competitors are embedding AI features and they aren't, your company risks becoming the old version of the product. The AI roadmap becomes part of the investment thesis.
But it's not automatically positive. AI initiatives can become expensive science projects. If data is messy, if teams don't adopt tools, if the model outputs aren't trusted, you can burn time and money.
So the new operational playbook includes basics that weren't always front and center: data governance, instrumentation, security, permissioning, and change management. Not glamorous, but crucial.
Let's talk about fundraising and LP relations. This is a quieter part, but it matters. Managers raise money by telling a story. Their edge, their process, their track record, their pipeline.
AI can help produce reporting that's faster and more customized for LPs, including risk exposures, sector concentration, scenario stress tests, and performance attribution. LPs can also use AI on their side to compare managers, detect style drift, and ask sharper questions.
Which means the bar rises. Vague storytelling gets punished. If an LP can quickly analyze a manager's portfolio, fees, and outcomes against peers, the manager needs a real, defensible differentiation.
Now let's address the elephant in the room. Does AI make private markets more like public markets? Because public markets are already information-dense and fast-moving.
To a degree, yes. Especially for late-stage private deals where there's more data, more comparables, more benchmarkability. But private markets still have things AI can't erase. Illiquidity, governance control, relationship dynamics, negotiation, and the fact that many companies don't disclose much.
So the market becomes more efficient than before, not perfectly efficient. That difference is where strategy still exists.
Let's get practical. Who benefits most from AI in private capital? Is it the mega funds with resources or the smaller funds that can move faster?
Both, but in different ways. Big funds can build proprietary datasets, hire technical teams, and integrate tools across platforms. They can invest in internal systems and make AI a core capability.
Smaller funds can benefit because many AI capabilities are becoming off the shelf. You don't need to build everything. A lean team can use modern tools to look bigger than they are, more coverage, faster diligence, better reporting.
But there's a twist. As tools commoditize, the differentiation shifts to data access, workflow integration, and decision discipline. The fund that actually uses the tools correctly will beat the one that just bought subscriptions.
Let's talk about risks and ethics, because private markets can get messy. Privacy is a big one. If you're scraping alternative data, where does it come from? Is it consented? Is it legally usable? Are you inadvertently using personal data in ways you shouldn't?
And then there's model risk. If an investment team relies too heavily on a model that's wrong, the losses can be huge. What's scary is that early on, the model might look right because the market regime matches its training environment.
There's also the question of fairness. If AI systematically favors certain geographies, founder background, or business models because of historical data, it can reinforce existing biases in who gets capital.
Funds will increasingly need governance around AI use, documenting decisions, tracking what data sources were used, testing for bias, and setting rules for what can and can't be automated.
And don't forget cybersecurity. If you're bringing AI into sensitive deal data rooms, and portfolio reporting, you're expanding your attack surface. One leak can be catastrophic reputationally and financially.
Now, the talent angle. The classic private equity career path is analysts building models and decks, associates doing diligence, partners doing relationships and decisions. AI changes the apprenticeship.
If the first draft of the memo is automated, juniors might do less of the grinding that used to teach them pattern recognition. On the other hand, they could spend more time on higher value work earlier, like customer calls, market mapping, and thesis testing.
It probably means teams will want hybrid profiles, people who can think commercially and also understand data. Not everyone needs to be a machine learning engineer, but investment professionals will need to be fluent enough to ask, where did this output come from and what could be misleading?
Let's finish with a big question. In an AI-rich private capital world, what becomes a durable edge?
I'd say 4 things. 1. Differentiated access, real relationships, proprietary deal flow, unique sourcing channels. 2. Proprietary data, information you can legally and ethically gather that others can't easily replicate. 3. Operational capability, actually improving companies, not just buying them. And 4. Judgment, the human ability to weigh messy, incomplete information and make a call.
I'd add a 5th, trust. Founders and management teams choose partners, not just capital. If AI makes everyone faster, the human part stands out more, not less. Who do you want on your board when things go wrong?
That's a great point. AI can compress analysis, but it doesn't replace partnership. And private markets are still, fundamentally, long-term relationships under uncertainty.
So if you're listening and you're an investor, a founder, an operator, or an LP, here's a simple takeaway. Don't ask whether AI is coming to private capital. Assume it's already here. The question is whether you're using it to make better decisions or just faster ones.
And if you're building the next generation of tools, remember the real constraint. Not the model, but the workflow. The best AI in the world doesn't matter if the investment team doesn't trust it, can't audit it, or can't integrate it into how they actually decide.
That's it for today. Next time, we can get even more specific, like how AI changes private credit underwriting, or how secondaries investors can use AI to value portfolios faster. But for now, keep an eye on the quiet parts of the market. That's usually where the biggest shifts start.